Just a short background on myself. I used to be a Delta One trader here in Hong Kong at Citibank. I'm primarily responsible for market making exchange traded funds on the Hong Kong and Singapore Stock Exchange. And fortunately, I lost my job at Citi and I discovered Bitcoin, and that's how I sort of got thrown into this whole arbitrage arena. Back in 2013, the first futures exchange opened, and it was a bunch of Russian dudes. No one knew where they were. There was no company. It was just a pretty shitty HTML website, and that was the futures landscape. And what I saw at the time was that you could make 200% per annum applying the most simple financial strategies that I did at my regular job, and then I imported those over to Bitcoin. Now those returns have come down a lot as more attention and there's more platforms offering these products. But if you compare the returns you can earn doing similar strategies to stock or index futures, you can make a lot more money if you're willing to take the risk and invest the time in learning. So that's what I'll be talking about today. So first, just a little bit about BitMEX. So we launched in November of, should be 2014. In the past 2 years, we've done about 2.6 billion US dollars of turnover on our Bitcoin and altcoin derivative products. We just recently became the largest Bitcoin US dollar exchange by turnover. We do anywhere between 10 to 15 million US dollars a day on our Bitcoin US dollar products. And we have over 15,000 registered users. All right, so let's just get into Bitcoin futures. So this is very conversational, so if you do have any questions, put up your hand and I'll try to answer them. I'm assuming that everyone has some sort of financial services background, so I might use some terminology that maybe some of you don't understand, so just raise your hand and make me clarify. So the most popular type of futures contracts that exist right now are quarterly contracts, meaning they expire every 3 months. March, June, SEP, and DEC futures. We currently have US dollar, Chinese yuan, and Japanese yen denominated futures contracts versus Bitcoin. And each one of these contracts has a different multiplier. Basically what this means is what you're trading is a fixed amount of some fiat currency in Bitcoin. And I'll go over why we do that in a few minutes. Settlement day is the last Friday of every month at 12 UTC. We take a 30-minute TWAP between 11:30 and 12 on settlement day, and that's how we come up with our settlement price. And everything is cash settled in Bitcoin. So BitMEX and all of our competitors are all purely Bitcoin exchanges. So you can't give us dollars, you can't give us Hong Kong dollars, you can't give us another digital currency. You can only give us Bitcoin. We happen to offer the highest leverage of any exchange globally on our US dollar and CNY products. It's 100x leverage, meaning initial margin of 1%, and we call your position or liquidate you when you get to 200x leverage, which is 0.5%. That's quite fun when you're trading the most volatile asset in the world. So the structure that us and everyone in the industry uses for our futures contracts is an inverse structure. So this is an example ticker. This is our DEC 16 Bitcoin US dollar futures contract. As I said, your margin, your profit and loss are all denominated in Bitcoin. You will quote your price in US dollars. Now, because we are settling everything in Bitcoin, but we're quoting in US dollars, some funny math had to be done. So instead of trading Bitcoin US dollar, which you would expect, you're actually trading US dollar Bitcoin. So the inverse of the pair that we're used to seeing. Now this is because Bitcoiners are extremely lazy. They want to see everything in US dollars. That's what we're used to. We don't want to quote amount of Bitcoin per US dollar. So what the first exchange that opened in around 2011 did was came up with this structure, where basically a contract value is a negative number. Now you'll never see this displayed as a negative number on our front end, but if you go into our engine logic, you'll see that our contract value is negative, and that's because we're trading the reciprocal. Now this has interesting effects that I'll show right now. So all this will be made available afterwards if you want any spreadsheets or the presentation. So here I have this DEX 16 Bitcoin US dollar future. We have a negative $1 US contract value, and let's say that we trade 10,000 contracts. Now each contract is worth $1 US. So when we put in a number of contracts, that's the US dollar amount of Bitcoin that we're trading. Now the Bitcoin value of that will depend on the price. Essentially, we're talking about a 1/x function. So let's assume that Bitcoin US dollar price is 100, then $10,000 is worth 100 Bitcoin. Very simple. And you'll see this is displayed as a negative number. The reason is, let's assume that you go long this contract. You are long Bitcoin. If you increase the price to 200, the value in Bitcoin goes to 50 Bitcoin. So if you just do a last minus initial calculation, you come up with a 50 Bitcoin profit. Now, if we change the sign to positive, then the math doesn't work when you go long these contracts and the price rises. All right, so this is a very important graph to understand the behavior of these contracts. Now, essentially, I've just plotted the price of Bitcoin from 25 up to around $750. And I've showed the value of these long 10,000 contracts in Bitcoin terms and in US dollar terms. Now, what we can see is that the US dollar value of these contracts is fixed regardless of the price of Bitcoin. So when you trade these contracts, you're locking in the US dollar value of Bitcoin at any price. And then as we see here, we have a classic 1/x function, asymptotic out to infinity and 0. So what this basically means is, if you go long this contract, the maximum gain that you can make unlevered is 100%. Because you're actually trading a reciprocal. The reciprocal can only go down to 0. So when I go long this contract, I'm actually going short US dollar Bitcoin. If you go short something, the maximum can go to 0, meaning you've actually only made 100%. Whereas your loss can go to effectively infinity. So what this means is, if you go long these contracts and you put up margin in Bitcoin, if the price falls 50%, you lose all your money. Which is contrary to what you would believe if that I fully margin a position and the price can drop to 0 before I lose all my equity. So essentially, because of the way that we need to trade and the way that clients want to view their positions, you're actually trading a quite exact derivative. Most people don't understand this, but this has interesting implications when it comes to how your positions are margined. Because again, everything is margined in Bitcoin and not in US dollars. All right, so essentially what arbitrage is in the Bitcoin world, as with anything, is creating synthetic US dollars by combining Bitcoin and Bitcoin derivatives. Now, most of the people in this room who own Bitcoin are obviously very bullish Bitcoin. They're bullish Bitcoin because it's either going to be worth a lot of money, like tens of thousands, millions of dollars if Bitcoin is created with gold or whatnot, or it's used as frequently as Visa or MasterCard. Or it's going to be worth nothing, or very close to nothing. So essentially, when you're buying Bitcoin, you're buying a call option. And your upside is massive and downside is limited to what you put in, i.e. your premium. Obviously, this isn't lost on everyone in the Bitcoin space. We're all greedy speculators. So essentially, speculators are willing to borrow unsecured US dollars on different trading platforms to buy Bitcoin. The question is, who is going to lend these US dollars to these speculators? That would be anyone who's arbitraging the difference between futures prices and spot. So essentially what we have done is created a sort of euro-dollar market where your euro-dollar is basically long Bitcoin plus short futures. And I'll show in a subsequent example why, regardless of the price of Bitcoin, if you have this position, you effectively have created dollars, and you are lending these dollars and earning a return. So futures in Bitcoin tend to trade in contango. And that's basically because, again, speculators thinking the price of Bitcoin is going to skyrocket to some ridiculous level are willing to pay very, very, very high interest rates. And essentially, what this interest rate represents is the unsecured rate of US dollars plus counterparty risk. Counterparty risk is very, very real. BitMEX, which used to be the largest Bitcoin US dollar exchange, was hacked for $70 million earlier this year, which was the second largest hack of Bitcoin. In 2005, Bitstamp, another large Bitcoin US dollar exchange, lost $5 million. The year before that, Mt. Gox lost $500 million US dollars worth of Bitcoin. Which basically means if anyone holds US dollars on a Bitcoin exchange, they're very afraid. Which basically means the amount of US dollars that are able to be lent to speculators to borrow is limited. Therefore, the rate of return needed to coax you to give your money to an exchange needs to be very, very high. So, the simplest arbitrage strategy is cash and carry. Essentially, you will purchase Bitcoin with dollars or Hong Kong dollars in this room. You'll need a margin position. You'll send a portion of that Bitcoin to BitMEX. The majority of your funds you will send to a cold wallet or any wallet that you control with private keys that is off an exchange. You will sell futures contracts to lock in the US dollar value of your position, and then you'll earn the difference between where the futures is trading and the spot is trading. At expiry, you either realize that position by selling the profit or loss on the futures contract plus your long position in Bitcoin, or you will continue rolling your futures positions. All right, so this is a very simple example. Let's assume we have 10,000 US dollars. The Bitcoin, go ahead.
Just zoom in.
Oh, sure. All right, cool. All right. So let's assume we have 10,000 US dollars, Bitcoin's price of 100, and let's assume that our debt futures contract is trading at $120. So first step, we send our 10,000 US dollars to an exchange, we buy 100 Bitcoin. So now we need to calculate our anticipated profit. Our anticipated profit is going to be in Bitcoin, not in US dollars. So we actually have, not only do we have delta on our principal, we also have delta on the profit that we anticipate to make by the time the futures contract expires. We need to hedge that as well. So we know we're going to make 2,000 US dollars, which is basically just 100 Bitcoin times the difference between the spot and the futures contract. So essentially, we have 12,000 US dollars that we will have at the end by the time the futures contract expires. So very simply, we need to sell 12,000 contracts of this particular futures contract. We have $12,000 of Bitcoin that we know we're going to have. We've sold $12,000 of future. Very simple. Next step, sit there and wait until the end of December until settlement. Now here is just a little representation of why, regardless of where the price of Bitcoin settles at expiry, you will have $12,000. So here we just have a bunch of settlement prices. This is the value of the 100 Bitcoin that we purchased at this price. This is our profit and loss on our futures contract in Bitcoin. Remember, our profit and loss is denominated in Bitcoin, not in US dollars. So at the end, we need to convert this Bitcoin profit into US dollars. That's the US dollar value of our P&L, and that is the sum in US dollars. And as you see, regardless of where the price of Bitcoin ends up, we have made a 20% profit on our money. All right, so just a bit about settlement. On our particular exchange, settlement is a 30-minute TWAP, and we take 1-minute slices over those 30 minutes on the reference exchanges. As I said, the futures are cash settled in Bitcoin. Now, obviously, you don't want to just do this trade once. You want to continue to roll your futures contracts after every expiry. Generally speaking, the longer dated futures contracts, i.e. quarterly futures contracts, roll expensive. So by the time December 30th comes around, you can buy back your DEX 16 futures contract and short H17 again to put on another funding trade. Now we experimented with offering calendar spreads between the different expiries, but many traders didn't understand them, so we kind of ditched it. But now we're thinking about bringing those back, so you can actually, as you would trade, HSC, HSI rolls every month, you can trade the roll between the different quarterly contracts in one atomic operation, which is much easier than manually going buy sell. So here is a real-life example of how much money you can actually earn. So this particular contract, our DEX 16 Bitcoin US dollar contract, was listed on the 27th of October of this year. Now this is basically the outright difference between the futures contract and spot. So as you see here, these are the different interest rates you could have earned by putting on this funding trade. And obviously they've tended down towards zero as the time value evaporates from the futures contract. But as you can see, these are very, very high interest rates when you compare them to other things that you could be trading in regular equities or FX or commodities. All right. Any questions on that? So this is, if I put this trade on the 4th of November, I would have earned 6%. Did it. That's it. And then sit and wait on December 30th, you would have made the difference.
So, quite volatile, right? The prices.
This is the basis, basically.
That's the basis, but the actual futures are quite volatile.
Yeah.
Can you talk a little bit about the liquidity of those futures, and then if there is a mark-to-market, you've obviously got to post additional margin against that.
Yeah.
Getting out of cold storage, getting it to you. How easy is it?
So this particular contract trades about 3 to 5 million US a day in volume. And yes, they are quite volatile. So what I usually recommend is take 90% of your Bitcoin that you've bought, put it in cold storage, take 10% and put it on the exchange as margin. As I said, you can go up to shorter X leverage before you get called, so you'll have sufficient time once the thing starts moving against you to get your money out of cold storage and then put it back on the exchange to cover your margin.
Now, you have intraday calls, though, right?
Yes, it is automatic. So if you get your liquidation price, that's it. There's no end of day marking.
So going from your cold storage, I mean, how do you actually do that?
So some people can do it programmatically. So they have bots that will see their liquidation price and automatically chop up their account. Some people, if they really trust us as BitMEX and want to take our counterparty risk, will fully fund this trade. So if I buy 100 Bitcoin, I take the 100 Bitcoin and put it on BitMEX, and then short the equivalent amount of futures contracts. That effectively is US dollars and levered at 1, regardless of the price of Bitcoin. So you'll never get called to do that. But then again, your whole principal plus interest is subject to our counterparty risk.
Towards over 5,000.
Yeah, so let's see. So this is a live market for the DEX 16. So what is it? It's about $0.50 for $3,000. And then it's a little bit wider, so about $1.50 to $30,000. I'm done. But most of these are market makers, so if you have an algo that's trading this, you just do TWAP or an iceberg order, then you won't be eating through a lot of flow. All right, so the next strategy, and probably a little bit more simple, which a lot of people get started doing, is arbitraging the difference between different Bitcoin exchanges. It's very common that an exchange in Hong Kong and an exchange in, say, Europe will have a different price. And since Bitcoin is fungible and US dollars are fungible, you can arb the difference between these exchanges. The only problem with doing this arb is that you need to have Bitcoin ready to sell immediately when you buy it. And that exposes your collateral to price risk. So what more sophisticated people who do exchange between, arbitrage between different spot exchanges do is they hedge or they earn carry on the Bitcoin that they're using to do arb with. So essentially what you'll do is you'll take your money, you'll split it into a portfolio of US dollars and Bitcoin. You'll take your US dollars and deposit them on a historical exchange that trades cheap. You'll send a portion of your Bitcoin to BitMEX for margin on your futures trade, and the rest of the Bitcoin you'll send to the exchange that historically trades expensive. And then when you see an opportunity, you buy cheap, sell expensive. And now you'll rebalance your portfolio and move the money back where it came from and repeat the process. Now this, in 2013, this was a very, very lucrative way to trade. In China, you can make 40% per turn. So as fast as you can get your CNY out of China back into Hong Kong is as fast as you can earn another 40%. And so that particular spread lasted for about 2 to 3 days. Recently, in Japan, you can earn between 5 to 10% immediately per turn. Basically, the price of Bitcoin, the JPY terms, is trading 5 to 10% above where it trades internationally. And that's basically because Japanese people don't trust non-Japanese people, and non-Japanese people don't trust Japanese people. So no one's willing to send money to each other's exchanges, so the prices go like this. And this has probably existed for the past 2 to 3 days, and it seems like it will continue to exist. So I'll show you a quick example. All right, so it says here we have 20 grand, Bitcoin, the futures contract, we use 10x leverage. We split our portfolio into dollars and Bitcoin. We take your earning carry on the Bitcoin that you have doing this arb. And then this just shows the operation of buying and selling. Assuming that, say, the expensive is at 100, cheap is at 90, you make $1,000 on the trade. Now, this was very easy to do manually 3 years ago. Nowadays, most people have automated trading systems that do all this. And as they notice arbs across the world, they just buy and sell, buy and sell, buy and sell. It's especially common in China, where there are no trading fees. So the only thing that really matters is the withdrawal fee of US dollars between different, CNY between the different exchanges. So effectively, your ability to earn money is constrained by how fast you can process fiat deposits and withdrawals and how much that costs on average for you as a trader. Now this is just a quick chart of the visualization of the different arbs across the world. You can find this on Bitcoin. They produce a nice little chart. One very lucrative way to make money is local Bitcoins. Once upon a time, I was the largest local Bitcoin seller in Hong Kong. And
my first Bitcoin I bought from him, actually, on local Bitcoins.
And so, because local Bitcoin is essentially just an escrow service. So as a seller of Bitcoin, I basically deposit Bitcoin with local Bitcoins. I post an advertisement saying I'm willing to take, say, Western Union or MoneyGram or a Hong Kong Pay deposit, and I'll send you Bitcoin once I get my money. Now, the premiums on local Bitcoins are very, very high. And basically, that's because lots of people won't tell you exactly what place you are in the queue, and that's because we don't want to expose too much information about the liquidation prices of traders in general. Exactly. So, once you think this is really awesome and I want to go make some money, the next thing is, how do you buy Bitcoin? So these are some of my recommendations. If you want to buy Bitcoin on an exchange, I would suggest Bitstamp or OKCoin. Bitstamp has a bank in Slovenia. OKCoin has a bank in Taiwan. Usually, you can get your money on the exchange same day. So if you send a wire from HSBC before 12 o'clock, I've usually got my money to Bitstamp by the afternoon or morning in the EU. OKCoin's big is in Taiwan, similar sort of time schedule. If you don't want to deal with an exchange, you can go to local Bitcoins. There are people who are posting ads on there, and you can buy Bitcoin in a matter of half an hour or an hour. Basically, just send somebody a bank wire to their bank, and they'll send you Bitcoin, and then you're on your way. I bought my first Bitcoins on empty docks, and luckily I got out of there before they went belly up. If you want to trade Bitcoin in China, that's a little bit trickier. You'll probably have to take a bus to Shenzhen, go to a bank, open a bank account, and then you can open an account at a Chinese Bitcoin exchange. If you want to try out this Japanese yen trade I was talking about, there's an exchange called Coin. They allow you to set up an account, and you don't need to have a domestic Japanese bank account to get verified. Today I was doing some checking around at the other large Japanese exchanges, and just about all of them require you to have a domestic yen account at one of the large banks, which is practically impossible unless you're Japanese, which is why there is this arbitrage opportunity. So in terms of how do I store my Bitcoin, which is, again, as Jan mentioned, very important. You don't have the private key, you don't own the Bitcoin. And sometimes exchanges get hacked. That's just part of the game. Bitco is an online wallet. Very good company. They try to excel at doing security for Bitcoin. The only downside to Bitco is every outward Bitcoin transaction, they charge you 0.1%. This is just a recent development that I discovered a few weeks ago. And so if you're willing to put in a little bit more effort, there obviously are clients who just don't charge you to send your Bitcoin out of the environment. In terms of a desktop wallet, Etherum is one of the best desktop wallets. There used to be a company called Armory that offered one of the most robust desktop wallets as well. If you want a mobile wallet, something called Mycelium. It's available on Android and iOS. Now, just a word of note, when you create any of these accounts, they're going to give you some backup codes. And best practice is to print out these backup codes and take them to your security deposit box, wherever that may be, or some secure storage facility, and put them there. Because invariably you will forget your password, you'll ding your computer and lose your hard drive. But if you have those backup codes, you can recover your Bitcoin. If you do not have those backup codes, your Bitcoin is gone forever. So when they ask you to do these backup procedures, pay very close attention and follow the instructions. Now, if you want to get set up with a Bitcoin exchange, the process usually takes between 1 to 3 business days. And as I said, they do KYC, so you'll need a government ID, address proof, and a bank statement. And generally 1 to 3 days to get set up. If you're really serious about this, you go to just about every exchange and you set up accounts. It's a bitch to do, it takes a little while, but when you see that arbitrage opportunity and you're already set up, there you go, then you can make money. And then on BitMEX is very simple. All you require is an email address in Bitcoin. Because we only deal in Bitcoin, we don't deal in any sort of fiat currency. All right. So we have futures contracts, and one of the new products that we innovated on is a Bitcoin swap. So one of the problems that we noticed with a lot of our clients was that they didn't like settlement. They didn't understand it. Why did my position go away? So we thought, well, how can we create a non-expiring derivative? And so what we thought of was a total return swap. One issue with that is, how do we determine what the interest rate is to charge between longs and shorts to entice people to take another direction of a trade? So what we did was we said, we'll do a look back on the average premium or discount that the swap traded against the spot market
and we'll charge that as a funding rate in the next period. And so what that means is, if the market's ripping and the swap is trading at a massive premium, the next period, if you short that swap, you're going to receive a payment. And if you go long, you're going to pay. And these interest rates get quite high. Right now, every 8 hours, the maximum it could go is 37.5 basis points. It used to be 100 basis points. So you have a situation where the market is really trending. You can make over 1% a day in just interest costs, and you put on a completely hedged position.
Does the interest reset daily?
The interest resets every 8 hours. So some clients and some market makers do a funding arb on the swap. Again, the swap is just another form of synthetic US dollars. Long Bitcoin plus the short swap is essentially dollars that you're lending to speculators. And if the funding rate is positive, you as a short holder derivative are paid. If the funding is negative, you pay. Now, if you put on this strategy since we launched this product in May of this year, you would have earned 30% outright. And that's just from shorting the swap, holding Bitcoin, and doing nothing. And I don't think the price of Bitcoin has even risen 30% in that time. So this is quite a lucrative strategy if you just want to earn interest. And basically that's because this product is leveraged 100x. So you're essentially lending a bunch of speculators a lot of money. This is just a very simple example of how we calculate our funding rate. So between periods, as I said, we look at where the swap is trading versus the spot price. In practical terms, we take a 8-hour TWAP with 1-minute slices of the premium that is observed, and then we charge that in the next period. So if you log on to BitMEX, you know what is the amount of money I'm going to have to pay on my position at the next funding time. Now, this is a discrete period, so if you hold the contract over funding, you are charged. If you get out right before funding is charged, then you pay nothing. So what you see, which is what you would expect with a floating rate bond, essentially, is a seesaw effect of the price of the swap. Now here's, as I said, we charge on the notional of the position we hold over time, and so this is just a simple little calculation of how much you would pay in interest. So this is our Bitcoin US dollar swap. As I said, this is our most popular product, and as we see here, it says funding rate of a very small amount in 33 minutes. And we also tell you the projected rate. So in the next 8 hours, we charge at 8 p.m. UTC, which is 4 a.m. Hong Kong time. If you're long, you'll pay pretty much 1.5 basis points on the notional of your position. If you're short, you'll receive the amount. So, putting this in practice, let's assume we want to create 100,000 US dollars that we're going to lend synthetically. Bitcoin 100, the swap is at $100. Now, what we've noticed empirically with the swap price is that this interest rate mechanism has been very effective. Our swap trades pretty much at the spot price, even when it's leveraged 100x. This is exactly what we want. So let's assume we purchase 1,000 Bitcoin and we sell 100,000 contracts. The swap has the same inverse structure as the futures contract that I spoke about previously. Now I'm just going to go through a one-period P&L. Assume that you have a funding rate of 25 basis points. So essentially your interest income is 2.5 Bitcoin. Now, if you're going to continually put this trade on, you want to re-hedge your interest income so that you continuously compound your earnings so you achieve even a greater return. So this 2.5 Bitcoin is worth $200, so you short an additional 250 contracts at the end of these 8 hours. Now this particular trade, if you just wanted to sit on it and not have to monitor at all, I recommend fully funding it on BitMEX, which basically means you have no liquidation price because essentially you've created a 1x leverage product. And this table essentially demonstrates that point. That even if I take the price down to $1 or I take the Bitcoin price up to $1,000, the value of my leverage doesn't change if I fully fund my position. Now, the only value where we get undefined is 0, because what is 1 over 0? So if Bitcoin goes to 0, then all this math kind of falls out the window. But we don't really have it. All right, so that is pretty much the end of my remarks on Arb. Some additional resources. We have a sample Python market making bot in GitHub. If you are programmatically inclined, you can use this. If you are comfortable with APIs and whatnot, I highly suggest getting up to speed on this. If I can count on the number of my hands people who actually do real market making or Arb using these algos, and they make a lot of money. We have a blog. I post, routinely do different trading ideas on our contracts. We have a YouTube channel where I have different lessons on some more advanced strategies of spread trading and curve trading using the different futures contracts. And then the example spreadsheet that I've shown here that will be made available publicly. So that's all, and any questions?
Do you know the breakdown of volume going to the APIs?
I'd say that our main market makers probably represent 75% of that. And that's just because they're quoting two-side markets all day. The good thing about our platform is if you post a passive limit order or a post-only order, you get 2.5 basis points rebate. So it doesn't cost you anything to trade. Yes, you make liquidity, you get paid. You take liquidity, then you pay 7.5 basis points on the majority of our products. What else?
What's the average leverage clients taking on your exchange?
10x. Most clients take 10x.
What's the hurdle rate? How come these ARBs still exist?
Because the majority of Bitcoin traders are technologists background. They don't understand finance. They understand this technology is amazing. I think Bitcoin is going to $1 million. They don't recognize that they're paying a lot of interest to get that leverage. And as I said, it's counterparty risk and lack of knowledge that this even exists. So when I was trading, I was getting 200% per annum returns on these strategies. One strategy, when the market was going absolutely ridiculous, you could sell a March 2014 future 100% output return in December. So I doubled my money in 3 months, basically by putting on short March long debt. So these things no one knows about them because it's a very small industry, and it's still very small. The amount of traders that are doing these type of things is probably 10 to 20 that are actually providing the majority of liquidity to the whole Bitcoin market.
So if you're going to short the swap, you're fully funded. It doesn't matter the price.
You don't care what the you just care that I'm going to make this interest rate. Now, could you have made more money if you just went long Bitcoin? Maybe, but then you need to time the market correctly. This is a strategy where it's just like a bond.